Hello, today is the 3rd of July 2011, and welcome to today's analysis. We'll take a look at platinum on the long term time frame, some gold on the long term, as well as silver using multiple different time frames. But we'll begin with the purchasing power and houses. In 1913, when the Federal Reserve was starting their reign of terror, the cost of a house was under 5,000 fiat dollars, and it wasn't that difficult to get over 200 of them with over $1 million. Today, you'll get under four. That is a major loss within your purchasing power of over 50 times. Now, when you use it within silver, you pretty much have maintained your buying power today. At least the cost of a house in 1913 was about 11 or 12 ounces of silver excuse me, you can get 11 or 12 houses with 100,000 ounces, which means a little under 10,000 ounces for an average house today. We'll start this off with some platinum. This is the quarterly chart of platinum going back to 1975. A quarter representing 3 months. And like silver, like gold, and everything was inflating at the end of the 1970s, and we've seen the price of palladium rise from about 140 upwards to about 1,000. That's about an 8 times difference. Yeah, 8 times. Silver went from about 6 or so, or from the bottom of 5, and well, it went up to 50. That was about 8 times, really 10. Therefore, platinum and silver didn't do that much different during this time frame, but afterwards it did. From the 1975 lows to the 1980 highs, and like palladium, it actually topped in 1980, the March time frame. We've seen the rise bring us down to 250, which was a higher low from here, and a low that maintained to be yet another higher low to here, maybe another one in here, and I guess maybe this could even be a higher low because it really never signified much of a low in here. And now we're still waiting for another low. However, if we do the Fibonacci math from the high and the low, the high, which we can get a rough estimate, well, that's not a straight line, but we'll say it's about 1100. And the lowest point will be 140, we will say. So if we take the number of the top, which is 1100, divide it by the lowest point of 140, which gives us the difference of top to bottom, which meant it had a 7.85 times gain, and we'll put it to the power, in this case, of 38.2%. The reason why I want to do 38.2% is I want to get the lower number. If I want to get the higher number, I would do 61.8. This is the number the market must hold for that rally from 75 to 1980 become real. So we'll take this number that we did the power to, and then we multiply it by the low of 140. The support that it needed to hold was around 308, so a little over 300, which meant roughly somewhere around here, which even though it went below it was still support. Support, and again, support. Therefore, that level did hold. That told us the rally from here to here was real, and thus we've managed to make new highs on top of that level. If we continue on with the same sort of Fibonacci analysis again, we can make a safe assumption that from this high, from this low, or even this low, to this high, that this move here was a successful Fibonacci retracement. It looks like about a 50% from here, from this bottom point in 2000. And because of that, we know again that this rally, as of now, and here, seems to be successful. But the question is, for this selling here to become a success, and thus reverse the trend to a bear market, we would need to stay below the 61.8% variable. We can see that it's roughly about 2250 as a top and about 775 as a low. We'll get some approximate numbers, but that's all we need anyway, because a lot of times, like we've seen before, it's going to pierce a little above or below it. So we take 2250 and divide it by 750. We have 3. 3 times difference from top to bottom. Now we'll put this to the power of 61.8% and then multiply it again by 750 to get the area where Fibonacci will be located at. That would be a little under 1500. So we'll draw a line roughly around a little under 1500, somewhere in here. What does this tell us? Well, this tells us that when we came up to Fibonacci, it was not resistance. Rather, it got above that level. It's found support. It's held above this area now for 5 quarters, which would be enough to confirm that this move down to 700 is a failure. And when you got this confirmation, this means the chances you hit this high up top is high, with the making sure that, of course, that it stays above any Fibonacci support. Because if you fall lower, if it happens, even though it's confirmed that it's going to the top part, the odds are extremely favorable on any selling that not only if 38.2% becomes good support, but 61.8%. Meaning from this high to this low, 61.8%, I would expect to hold. Okay, now let's do some trend line analysis on this platinum chart. There really isn't that much to go over for trend lines. This trend line, I think, is the most significant one, because this is a trend line that held 75 at this low in here, and it was resistance in here, stabilized, and now it's back above it. But overall, there's not much in the area of that many significant support and resistance lines. Then this was the old trend line. If we go parabolic, maybe that's something we might want to look at. But overall, nothing too significant. Okay, now we're going to switch this on to gold. And for gold, we'll use the same thing, except for this will go back to, it will be 1968. And what's interesting about this chart for me is the size of the moves. The fact that gold corrected really through time and not price during the 1980s and 1990s. Because the movements in here, this little small area in here, this is where we've seen it trade roughly around the price we are today in the 30s. And the movements were small, in a quarter, $1 and change, or about 3-4%. And not so volatile. And then we had these decent sized green candles. Even some decent sized red candles in here. You look at these moves and you compare it with these moves. The candle sizes are much smaller today, meaning the volatility is a lot lower today than it was back then. And the movement of the rise from 250 to 1600 really isn't that big. In fact, if we take a straight line from point A to point B, and point B, of course, is not finished yet, but as of now, that's where it is. This would be peanut change compared to back then. It's the move of going from like 30 up to about 180, and the market went up to 800. So I find that to be very, very interesting how literally the gold market has been so slow. When you call a bottom with the silver market or the gold market like this, you call bubble action. Not really. It's not showing the moves like we've seen in here. So in order for me to see a bubble, I need something explosive to occur first. As far as resistance is concerned, within the original line, the resistance you'd be looking at would be the one that would contain This in here. And where have we went since this point? We're right there. We are right at this point, just staying within the trend. All right, it's been 10 minutes. I'm thinking about making this 2 videos. I was going to go, no, let's do it one. We'll finish off with silver. I'll go a little bit quicker within this, but go over what needs to be gone through. First, I got to find the chart. Alrighty, this is the this is a 6-hour chart. Each candle representing 6 hours. It's either from 12 to 6 or 6 to 12, twice a day, of course. The 2 trend lines that I think are important right now are these in here. It's the parallel lines that connects the trading range that the market is in right now. And the market is currently in a downtrend, making the pattern of lower highs and lower lows within a primary trend that has taken a miniature crash within a primary trend that is super bullish. And when the support levels hit 1, 2, 3 times, it's been doing very well. But the last time that the market had a move, it did not make it to the top part of this line, which gives you reason for the fact that the market could go below this trend line again. As a possibility, don't know what the chances of such a likelihood occurring, but what the big thing will be is this big support level roughly down towards 32 and change. This is an area that was hit on 3 different occasions back in the month of May. Has not been touched yet. However, it's getting much closer. The big 33.58 support level, it's holding so far. But again, that is only so far. Oftentimes when you get big levels of Fibonacci that are supposed to be support or resistance, and they are, when this is the case, then it's doing what it's supposed to do. And if it breaks below it, you would expect this area to become resistance again on any future moves. But for now, we'll get into it a little bit more when we look at the shorter term time frame. But that's the biggest one on that. The next one I want to look at is the weekly upside chart. And this works within the Fibonacci upside targets of the $4 low, which is the very bottom, and the $8 high, which is this top in here. It's a significant range that even goes back further from 2002. And within these Fibonacci levels, they've worked out extremely well. I don't want to go over them too much. However, if you notice that the market does manage to go higher, we will, at least I will say that this was a pierce above this Fibonacci level of roughly around 3140. If it manages to go down to 3140, the chances of having support there are pretty decent. Again, a lot of times you can break support, go back to the next one, and then go higher. So is it possible we go back to 21? It could happen, especially when you look at the quarterly chart, because that's its next level of support. Although I've actually managed to find one roughly around 25, 26 that I'll go over. Big thing is if we get by this level here, what's next? That's $75.78. Okay, now we're going to move on to volatility and quickly look at silver on all different time frames. So volatility on the market, this is using the 6-hour chart. It takes the average movements of top to bottom every 6 hours. That's from 12 o'clock to 6 o'clock and 6 o'clock to 12. And the average moves during this time frame right now, using the 5-day average, is roughly about 1.3%, about 1.5% on the 20-day moving average. The significant thing is that this is the bar that needs to be set for any another set of major moves. I've said it before, I'll say it again. I'm expecting one occasion, maybe 2, but definitely one, where this market or this chart will go very high, either testing these highs, maybe making new ones towards the upside. But most of the time when this market goes higher or this chart goes higher, this does mean lower stock prices or lower silver prices. Normally, though, when this goes lower, this means higher or straight silver prices, and it's been somewhat straight, but more so lower. So even though it's normally, doesn't mean that's always going to be the case. Now let's take a look at silver on multiple different time frames. Each one of these charts, with the exception of this one, has an 18 period average. This one has 20. The reason why this one is 20 is because of the 5-day moving average. The averages are front weighted. Front weighted means it puts more emphasis towards the more recent periods than it does the older ones. And within the daily chart, we have the significant Fibonacci mark at $35.03. And this level has now become resistance. You're seeing what looks like a possible failed move above this level, and overall it could be showing choppy action if he finds support here, but still a little bit of a warning sign that a failed move could bring a fast move towards the downside. These bands are not Bollinger Bands. None of them have been tested in quite some time. The next one is the daily chart, and amongst the daily chart right now, it's playing out amongst the 18 period average as resistance. I was stating before that what I was seeing, what could have happened, was a move back down to the previous lows, which obviously wasn't quite the case because it was a few inches from that area, but would come back to its previous level of support. And that's exactly what's happened, where the markets went below this support level, has came back and now found resistance. Because when you have support here that you haven't seen in a while, meaning this level hasn't been seen since here, and then you not only have a small move up to here, and then you come back below, I don't like the chances of it holding. In fact, rather, I'd like the chances that it's going to break below, maybe make a test of the regular 200-day moving average. But again, there's nothing here stating that the market wants to proceed higher as of yet. That trend line that I showed, that's the must break for the market to go bullish. Weekly chart. And for a while when I was showing this chart, it was showing an upward slant like this, and I changed the moving averages to front weighted, which has thus changed this to be a sideways action. And within this sideways action, the market's pretty much neutral now, maybe neutral with a down bias, but in order for me to see any bearish action, I need to see a break below this level here. Possible support might be this band. You also got this previous resistance, roughly at about $29 per ounce. I don't see the likelihood of the market going down too much lower and staying down below there. I've seen crazier things within this world, but the likelihood is not that big. Dreader was mentioning on an earlier video that it seemed everyone was buying when the market was going up here, and well, now they don't want to buy. A lot of times, they even want to sell. And well, normally people buy high and sell low. So if a lot of people are wanting to sell their silver, then usually that's a good time to want to buy. The monthly chart is the next one, and within this baby, we have this close to a Bollinger Band, which has been resistance for quite some time, and it's now coming back down to this moving average. So if you're looking for a spot, sometimes you wait for it to hit the somewhere within this level, maybe the middle part, lower part. Maybe you want to see it come from this level and break higher. It all depends on your risk tolerance. And it's an area, though, where it could very easily find support, but that doesn't mean that it always will. Just different areas that you look for support to be found. On the quarterly chart, as I was saying before, the biggest next level of support is like 20, or this Fibonacci line for that matter, which is 1895. Because you've got this pattern of this low, then you got this high, then you got this low, then you got this high. Where are we going to end up going as far as the low part is concerned? If this market continues to go higher, then this isn't even the high, because it needs to consolidate for 2, 3, 4 turns, or go down enough in price like it did in 2008. Right now, this isn't even officially yet the high on this chart, but it could be. However, future resistance is now at $20 or so, but if you're looking for this 18 period average of highs right now, that's set at $26.16 per ounce. And it wouldn't be that much of a surprise seeing a breakdown below that key 32 and then a quick move to 26. After all, that's only a $6 difference, or 20%. The move from 50 to 30 was even greater than that. And finally, we're going to take a look at the yearly chart. And I'm thinking about maybe even doing 9 months, but I don't know. I'll just probably stick with the year. It's easier. And on the yearly term time frame, I don't know why it's barely been even touching these lines. These bands, normally it should stay below it. However, when you're talking about inflation like this, it's okay. The best way for me to explain this is if you put the Dow Jones on this chart, the gold market, so many other markets, it would be well above this line, and just hugging it for so long, these movements should not occur. Like gold going sideways, that would be more accurate. And the reason for that is the simple inflationary values. Because if you have a move going from 50 to 4, not only do you lose 12 and a half times, but if inflation is triple, that's almost like silver losing 80 times its value. No, 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 that doesn't make sense. Or maybe 40 times, whatever. Because it's 12 and a half in it by itself. And then to lose that amount when prices were easily going up for 15 years, then that just shows you that these markets do not, I repeat, do not trade within a pure supply and demand mechanism. For pure supply, pure demand based on its underlying value it's measured in, which is that of fiat dollars. And I'm going to end the video today at this. It's now closing in on over 21 minutes, and thank you for tuning in. Take care.